Welcome to the Business Rebellion, the podcast for founders and leaders who know something about the way business is done doesn't sit right anymore. Not because they're failing, but because the model is broken. Today's episode is about something almost every business owner runs into at some point: lending. Trying to buy a home, trying to refinance, trying to understand what you can actually borrow, and realizing it's not as straightforward as it should be, because the way lenders look at business owners is very different to employees. And most people don't realise that until they're already in it. This conversation is about understanding lending properly, not just getting approved. This is lending, self-managed super funds and structure. My guest today is Melanie Cunliffe. Melanie is a mortgage broker who works closely with business owners navigating lending, borrowing power and structure, helping them make better decisions around how they finance property and manage risk. What I really value about Melanie's perspective is that she sees both sides, what founders think should be possible and how lenders actually assess things behind the scene. Melanie, welcome to the Business Rebellion.
Kerrie, thank you for having me.
So for most people who don't know your work yet, what kind of business owners usually come to you when they're trying to get lending approved?
Yeah, that can be very varied. So I think, as we all know, businesses and business owners come in various shapes and sizes. We could be working with somebody who might be a sole trader, right through to business owners who have multi-layers, could have, multiple different entities, different trusts, and also be involved with different people in different little ventures as well. So yes, it's never a dull day, I think, when it comes to working with business owners, which is one of the reasons I love it.
Yeah. And it's what you specialise in at Indigo Finance, right?
Yeah, we work with clients from all walks of life, but we're very passionate about working, with entrepreneurs and, be that entrepreneur through being a business owner or entrepreneurial through building wealth through property. But for business owners, often finance can be challenging, and it doesn't always need to be challenging. But I do think we have some kind of societal beliefs that, if we're self-employed, we'll never be able to get a loan. So yeah, I think it is quite rewarding to dispel that myth, because there certainly are a number of different borrowing options, and there's probably more in the market um, for self-employed borrowers than there have ever has been. So yeah, I think some of these things are old beliefs, and it's nice to kind of, break through that and help people still be able to achieve their dreams.
Yes, it's actually, you busted that belief completely for me. So that was a really good experience, because before I came to you, my husband and I were told no by every other bank, all the normal banks. And of course, both of us at the time were self-employed, and they just won't even touch you. And even when they do, they just restrict significantly. And I remember having that conversation with you that day. I said, yeah, all right, you can have a crack at it. Good luck. And it was just, it was like challenge accepted from Melanie, and away she went. And she waved her magic wand, and she managed to create a miracle, I would like to say. So she's a miracle weaver.
I think we can shine the best light on
Yes,
things.
absolutely. And you certainly know how to manage the different things from multiple lenders and how they've all got different criteria. And I think one of the other things that really struck me was, yes, you can still get the loan. Maybe the rate's not what you wanted, or it's slightly higher than what you wanted, but you get the loan. You get your foot in the door and you get started. And then the options are endless after that, right? Lots of things can change. So I really enjoyed that process, and everyone in the team were fantastic. So definitely, if you want anyone, Melanie's your girl in finance, right? And so what typically for business owners is happening for them at the point when they're thinking about trying to buy a home or refinance or just understand what they can actually borrow, what do you see is going on in their kind of head and their biggest frustration?
I think, one of the biggest frustrations would be already having made that assumption it's going to be hard. And so I think even when entering into it, it's something that we find maybe a lot of business owners actually kind of put off. and procrastinated about because they believe that it's going to be something that's going to be really hard. Or it could also be that they've had a conversation with their bank and that's made it feel really hard. And I think sometimes that can be a bit of a apprehension that people have. I hear so many people saying, I won't be able to borrow, I won't be able to borrow, where it's like, well, hang on, why don't we actually explore if you can borrow before we make that decision and that call? Because there's so many different options and approaches. And even if it's just, that your bank has said that something that's not going to work, that's them. It's not necessarily you. So I think frustrations can be just feeling a bit of anxiety about, oh my gosh, I'm self-employed and I'm going to have to borrow. What am I going to have to put myself through? And on top of that, like I'm running a business as well. So it's not like I can carve out all of this time to go, oh, this is my primary focus now. So yeah, I think that can also put a lot of pressure on people.
The other things that I notice when talking to business owners too is obviously they get really frustrated that their business is doing well, but the banks don't always count that.
Yes.
They kind of, there's a disconnect between that. They kind of treat the two separately and like, well, that doesn't matter. you know?
Yeah. Yeah. There's certainly different ways that we talk as business owners, the way that a bank's going to view things. In particular, for instance, when we're thinking about our business, we're thinking about what's happening now. We're thinking about, what's flowing through the books now. We're thinking about the day to day, and what we're doing and what business we've got coming in and revenue. Whereas when the bank's looking at things, they're always looking at things historically. So like, the traditional, bank approach would be looking at the last 2 years' tax returns. Right? Now, when we think about where we are now, so what are we? We're April 2026. Some banks are still working off tax returns that ended the 30th of June 2024. So when you think about that time frame and what can happen in business between those time frames. So what's interesting is because often when the banks are looking at things, they might even be looking to a very different business to what we have now. So yeah, I think that can be a big disconnect sometimes.
So much.
Yes.
I guess you got the other side of it where, quite often business owners often pay themselves the least.
Yeah, and this is the other side of things, right? If your accountant's doing a good job, then the income that they're showing on paper is as minimal as they can get it so that you can be most tax efficient, right? So, then we have to come in and kind of unwind all of that and try and pull out all of the income so that we can use it. So yeah, sometimes those priorities can be counterintuitive. It's interesting. We often, say to clients, if we're thinking about borrowing within the next year, then make sure to tell the accountant this. Because when they're looking at the books, there may be things that they add into one year or the other, or ways that they treat things that could be favourable or not favourable from a borrowing capacity perspective. But I think one of the other things also is, which I see a lot of business owners think that they have to pay themselves, like you said, Kerrie, oh, will we pay ourselves the least? But the when it comes to lending, we can look at the profit of the business. It doesn't mean you have to be paying yourself always. It could be that the business is retaining that profit, but we can still use it if you're the shareholder. So I think understanding those things also before you go and pay yourself, a large sum that's going to pay you a big tax bill is also understanding, do I even actually need to? Because you may not need to, and we can still use that income for borrow.
That's really amazing because, it's like if you took it out of the business context, it'd be completely different. Like, because you've got that profit that's sitting in the business account, just sitting there, and they'll let you use it when you're in business. But if you've got all that money sitting in a bank account when you're just an employee, they may not let you use that to contribute. So it's interesting how they treat the two very differently.
Yes. There's so many different approaches when it comes to lending when you're self-employed. And, each individual bank has their own, policies and appetite and also niches. So a lot of times, for instance, when we're looking at lending in the self-employed space, a lot of our decision around lender might come down to what is our client's business structure? What approach is going to work best to achieve what they want to from a borrowing perspective? And that can often influence what lender we go to more than just interest rate, because like you say, if we're able to achieve that bit more that they want to in borrowing capacity, then it's going to set them up to be able to maybe buy that slightly bigger dream home, or, that investment property that's going to make a longer term capital growth for them. There's a number of other things that can come into play here. One of the things when people say, what can impact my borrowing capacity? Often it's like the choice of lender can have a huge difference.
Oh, really?
Huge.
And how? How does that happen?
Okay, so to give an example.
Yes.
So as we all know, individual tax rates are higher than company tax rates. Agree?
Yep.
And most lenders will look at then, even if we're using company profit, when we're self-employed, most lenders will say, okay, well, if you're going to be using that income and you're going to be drawing it out from a personal perspective, we're going to treat all of it at a individual tax rate. There is a lender that we do like to use, whereby, let's say, for instance, we have a client that their business runs very profitably, but they don't take much out themselves. Then the lender will actually use company tax rate for that money. So when you think about then, when we think about borrowing capacity, the lenders are looking at what is your net income that you can use putting towards repayments. So if we're using, a 25% tax rate versus a 45%, then what's going to be left over is a lot more that can allow our borrowing capacity to be substantially different with that bank versus the bank next door.
That's a really big difference.
So there's a lot of intricacies, but just because we've been there, we've done that. Being able to look at someone's situation and I think know the little quirks and where is this going to work best, is when you can really, really maximize things, for someone that's self-employed, because there's so many different avenues that you can go down. I mean, when you're PAYG and you get 2 pay slips, there's not that much that you can do. You might be able to trim some of your expenses or, but when you're self-employed, there's so many different ways that we can look at things. So it really is kind of understanding the business structure. And I think as, my top tip for someone who is self-employed and looking at borrowing is it's so important to align yourself with a really good, broker that is an expert in self-employed. So I would be, if you're thinking of using someone, asking them like, how many client structures have you worked with that are like mine, because that'll be really, really important and can make a really big difference, when it does come to borrowing. Yeah.
What's the most common reasons business owners get declined or limited when they apply for lending, do you think?
I'd say maybe going to their own bank.
Vouch for that. Yes, 100%.
I think we have this, and look, it's beautiful and it's lovely, but this feeling of like, oh, my bank, I've been with them, since I had my first bank account, like, surely they're going to understand me,
First Dolomite account together.
Yeah. And they can see everything and they know me so well. Sometimes you might not want someone to see everything or know you so well. So yeah, I think, that happens, and, especially where I hear there's something about, I don't know, we get kind of stuck with the family banking institution. I hear a lot of this where we have clients and it's like, yeah, but their parents have banked with that particular bank and that particular banker for so many years, and they're like, oh, we should, go to that family banker. And even when it's things like the interest rates are higher, they're not able to borrow as much, they find it really hard to kind of break up with that bank. So I think really, the biggest mistake that I see in that respect, or people get declined, is then because they only rely on that and think because that bank has spoken that's gospel, and that's what they can do, and not even actually realizing that different lenders look at things differently, And I'm not just talking about, using things like non-conforming lenders. I'm talking about if you took the big four, each of them looks at a self-employed borrower very differently. So,
Fascinating that they're hooked on that whole family loyalty to the bank, but man, they'd drop you in a heartbeat
oh,
if they thought that they could get higher interest from somewhere else. They don't get the cheap interest rates to the existing members. It's always the new ones.
yeah, and the thing that we also see is, that it gets deeper and deeper, because the more you get tangled and you do that next property with the bank and then the next property with the bank and then the next, and before you know it, and then you get an overdraft for the business, and then that might be secured by one of the properties, which is actually kind of cross to your home. And before you know it, you are woven into this web, right? And it's really hard to get unstuck from it. It is, right? And then you end up in this, trying to do you untangle, and then you've kind of limited your options because you're kind of stuck, and then you end up just having to stick with it. So yeah, it's an interesting, spiral to go down, and the banks, for instance, they love like cross securitization, let's say, right? And that's where maybe I've got my home, I want to buy an investment property, and they go, oh, that's perfect. We'll take your home as well so that you can buy the investment property. We'll give you one nice, simple loan, but we're securing everything. And then you're all really tied together for those things, If you wanted to sell one of them down the line, it can be trickier. You can't leverage if the equity in one of them goes up unless the equity in the other one's gone up as well. So there's a number of things that can happen in that respect. But the bank loves it, That's something like with our clients, there's like no cross securitization. Like that is a hard and fast rule. There is no need for it. It is purely to make you stickier, So there's things that you kind of get pulled into in banking land, that you don't necessarily need to be.
Oh, we'll make it so much easier. We'll just do it all together. Just one payment. It's all right. It's got nothing to do with us at all. So what other patterns do you see where the founders think that they're in like a strong position from a lender's perspective? They're not quite really. Where do you see that kind of pop up?
One of the things that I think comes up a cropper against people sometimes is where they have trust and distribute to family members. So we can see this, the trust is doing really well. There's, got income flowing in. But if that's being distributed out to other family members, the bank doesn't necessarily always want to use it. Again, some lenders are better than others, with this. But this is something that I do see, come up, and impacts people. And yeah, maybe great tax efficiency. But again, if we're thinking about borrowing, if we're thinking about borrowing in the near future, sometimes we just need to look at these things. And it might just be, okay, well, we won't for this year. It doesn't mean you can't ever do it again, but maybe just for this year, because we're thinking of borrowing, just take those extra steps, do you know what I mean? To make sure that we're going to keep our options open.
It's an interesting one. I didn't even think of that. That's, yeah, okay. So, and a lot of founders, so they approach lending, as we've already discovered me today, as a yes or no kind of outcome. So how should they be thinking about it more strategically, and what changes when someone starts planning for that lending 6 to 12 months before they actually apply?
I think it allows to have more options. If we look at something, and we go purely in this point of time, what do we have to work with? That could then determine what those options are. Whereas if we're looking at things ahead of time, we have a bit of time to get things in order. So when we're working with business owners and talking about planning things, it can be talking about, are they going to be taking a salary this year? Because believe it or not, we now have lenders that will rely on pay slips, just the same as an employee, right? So, for some people, but these things need to be planned ahead. We can't just suddenly start paying ourselves a salary and be like, that's it. So planning ahead for these. Yeah, yeah. So planning ahead for these things, can really set us up to be in a good position. Um, Also being able to work with the accountant, like we'll often, and like now is a perfect time of year, right? Because we haven't closed out for year 26 yet, but we're very close towards the end of knowing roughly what our numbers might be looking like. But we're getting to the point now where the accountant might finalize and say, actually, you're going to take it as a dividend, or we'll take more as a bonus, or we're going to put more in super. What are we going to do with these things? So it's a great time now for us to be looking at things before things are finalized, before they distribute out, before they distribute to the children, and decide, what's going to look best from a borrowing perspective to keep somebody's options open.
It's all about the options, right? The more you plan, the more options you have. Everything in business, the more you plan, the more options you have. So it doesn't surprise me that lending's no different.
Yeah, and it can be also planning on what debt requirement we're going to have that might come up in the business and how is that going to affect our lending. So one of the biggest culprits is vehicle leases. This can really impact our borrowing capacity. A lot of people sometimes think, oh, but it's in the business. It's still you, like when the bank comes to it, they're still looking at you. Again, some lenders might mitigate and leave it out, but again, that comes to how are we drawing the income on whether can we leave it out or not. And this is that kind of planning piece, that comes into play. So a lot of our clients will say call us and say, hey, I'm looking at buying a car. How is this going to affect my borrowing capacity? And we might talk with their accountant and go, we'll structure it this way so we're not going to have as much impact, or do it over a longer period of time, or, things like this, because these things can dramatically impact our borrowing capacity as well.
That's always the worst thing. That always doesn't matter whether it's business or normal lending, the car kills everything. car loan.
And it's often a bit of a impromptu, but once we see it and we want to get it, right?
It's a necessity. You've kind of got to drive somewhere. It's Sydney. So what happens when business owners rush into that decision without the right preparation or structure? Like, what do you see people carrying financially or emotionally because they didn't do it properly from the start?
Yeah, I think being stuck in a loan structure or with a lender that wasn't necessarily the best outcome can impact you down the line, especially I think for investors. So when we're looking at investing, I think sometimes people think, oh, I get that first loan, I get that second loan, and it's often that third or that fourth loan where they start to get really unstuck, and things are impacting. Whereas if we instead think about it very early on with that first loan and making sure that one's correct and structured optimally, and the second one is as well, you'll find the third and fourth are a lot easier to do. Because sometimes the things that we've done early on without structuring things correctly or with the right lender can really impact us. It could be that we've gone principal and interest on maybe some investment loans when maybe we could have been interest only and that could have benefited us. There's a number of things, and it's not that these things can't be unstuck, but the further down the line we get, the harder they are to I guess unstick essentially, and the harder that the work might be involved in doing it. A big one I see is too when people have maybe bought an investment property and they put a bulk load of maybe cash down, rather than borrowing, so they haven't got those bigger tax deductions, or there's a few things in that respect. So I think getting the right advice early on is super, super important, especially if you're going to want to be borrowing, in the future, and also have flexibility, to be able to do things in the future, because there's enough pressure on other areas, right? And running a business, like you don't really want to have to be worrying about those things. So we always find like flexibility is key.
The other thing that I noticed, like in the circles that we kind of hang around in often with the business owners, is a lot will actually use a self-managed super fund. it's quite common that, most, because business owners love flexibility, right? So we just kind of go for it everywhere. And that often then comes up in our super fund as well. So when they start thinking about property from a lending perspective, where do you see business owners getting confused about how self-managed super funds actually work with that lending side?
Um, I think some of the key things is knowing when can a super fund be used and when can't it. A super fund, you can't live in the property, so it's quite clear that it needs to be income producing. And also the fact that it needs to be standalone. So if you're buying a property in the super fund, I think a lot of people are attracted to it because they go, oh, I've got a decent amount of cash in there. I want to do something with it. This will be a great vehicle. But it's understanding, like, it's not easy to get money, into you, and you definitely can't get it out of, right? So there are limitations that when you do look at borrowing in the super fund, it's something that needs to be very well thought through, and you need to be working, with your advisors in order to be able to look at it, because you really want that to be self-sufficient. You want it to be self-sufficient in being able to meet its own repayments and look after itself, and not draining you too much elsewhere. Because I think when people look at it, they go, oh, it's great, I'll just buy it in the super fund. But often when we're buying, let's say, an investment property, it's going to be often running, a bit of a loss, right? So, I think forgetting sometimes that they're going to have to top that up, from their own income, is something that sometimes gets overlooked.
Yes, yes. Also, the lending, it's a bit more restrictive in a super fund.
Absolutely. So the self-managed super fund is, without me going too much into I guess strategic investment advice, but the super fund really, when it comes to lending, is designed to be, let's make this safe. Yes, we want to be able to borrow, but we need to remember this is your retirement. We need to make sure it's in a safe environment. So the type of property and what you're doing, I think, is it needs to be lended well to the super fund. So, for instance, in the self-managed super fund, if you pay an extra into a loan, you cannot redraw that back out like a regular loan. So this isn't going to be that kind of loan. If you pay extra money off it, then that's it. You're not going to be able to access it again. The other thing is, if that property goes up in value, you cannot borrow against that property again. The only time you can borrow is at the time when you buy the property. So therein, you want to be borrowing enough because you can only borrow once. So you want to maximize it at that time, but at the same time, keeping it, within safe borrowing levels as well. So there's certainly some restrictions, when it comes to the lending perspective that are different to outside. And I think a lot of people think, oh, I'll buy the property, it will go up in value, and then I'll borrow against it in the super fund to go buy another property. Whereas you just can't do that. The only way you could realize that increase in value is if you sell the property.
Yeah. And they even go down all the way down to like the risk profile of a suburb. Like some postcodes, they just won't lend to it.
So within the super fund, they can be tighter. The pool of lenders is smaller.
Yeah.
So whenever our pool of lenders is smaller, there's always going to be, less options available, and they can be quite particular. I think around especially things like the size of land, the nature of property that we're buying, they can be quite restrictive. If it's standard residential, there's quite a lot of options now, in that space. But yeah, certainly when we're looking at properties that might be slightly quirkier, they're or slightly more specialised, then the lenders can certainly have more restrictions because they deem it as a higher risk type transaction.
So it's interesting. So there's quite a few things that business owners often overlook, and we've covered off like a lot of those things there. And I think I do find it quite fascinating, that whole process, because it's not simple buying a property in a super fund.
No.
It's not like when you buy it in your personal name, it's relatively simple. There's the lending and the contract's simple, and but the whole process in a self-managed super fund, there's additional trusts and there's additional setups and structures that have to be in place before you can even go down that path. So it's, I guess, they probably do that for the reason that they need to slow down the scattergun approach, would use.
Yeah, I think buying in the super fund is definitely something that needs to be well thought through. Because indeed you're setting up other entities, you're essentially setting up another business, right? So you're going to have more accounting fees every year, you're going to have all of these things. So yeah, I think it does take some planning to make sure it's going to be right for you. But like on the upside, we've got a number of clients that have used their super funds very, very successfully, and it's worked very, very well, for them. So I think in line with the right strategy, superannuation in itself, I think is one of the most, like under, it's kind of seen as like a little bit like daggy in a way. It's like, it's like we think about super funds as like when we're nearing retirement, whereas actually it's an awesome, when I learn about the tax benefits in a super fund environment, I'm like, that's really cool. So yeah, I think it's often viewed in a slightly different way. Whereas when you look at, some of the benefits and the benefits of owning property in the super fund, and if it's done right and you've got the right advice, we see it work really, really well.
A bit more flexibility and choice. You go to a standard super company, whatever it may be, it's you tick a box as to what you want to invest in. You don't really get much of a choice. You can't go, no, I don't want those shares. I just want Apple.
Yeah.
Like you don't
Yeah.
get that choice.
Yeah.
Tick a box in risk factor. And I think in this, it's nice to know that in the self-managed super fund, and it's the thing that I like the most, is that I get to choose. So if I wanted to buy a Picasso because I think that that's a good investment, then, I might be able to. Probably not, but might be able to. Artist dies and buy their work. So,
Yeah, I think the super fund where it works really well is where we see for business owners is buying their own premises.
yes, I've heard about that. So that's the commercial property side of things.
Yes. Yeah. So while in the super fund, you can't live in a property that it buys, you can own or occupy by your business. And I think this works particularly well because hopefully you've got a good tenant when you do it.
No, they seem a bit untrustworthy.
And there's flexibility to decide kind of things like, well, who's going to pay outgoings, the super fund or the tenant, So there's some kind of flexibility with these things. So yeah, we can see it works really, really well, when people are buying their own business premises.
That's a really good. Everyone keep an eye out for that one. So, in your experience, so when does using the self-managed super fund for property lending make sense compared to creating more complexity than actual benefit?
I think buying your own premises, definitely something worth, exploring. I think when does the complexity get too much? I think looking at the cash flows first is really, really important. Making sure you're comfortable with those cash flows. And I think also, doing exercises around sensitizing, what happens if rates go up by a few percent, because those are the things that you'll need to consider of how am I getting extra money into the fund in order to cover any rate increases, because it's not as simple as, oh, well, I just won't have that coffee, because obviously we know there's tax implications of being able to get the money into the fund. So I think those things are really, really important. That when can it can create more complexity? Well, if you're going to have problems like that are going to come up that are then going to cause you more stress because you've got to get money into this fund to cover the loan repayments, those are the kind of things that I would say it's going to cause, maybe more complexity than needed. And I think doing it just for the sake of it, going, oh, I've run out of deposit. Like we see this sometimes, I've run out of deposit elsewhere. I've got something in the super fund. Okay, let me just do it there, rather than it being part of a bigger strategy approach. I think that's really, really important, that it should always be part of an overall strategy.
So many of our listeners are obviously running service-based businesses with small teams. They already carry a lot personally. So how does lending, especially when it's tied to personal income or guarantees, impact the pressure of a founder feels day to day? What do you see?
Yeah. I think it maybe comes back to a bit around that when people go with their bank and they get very tied up and they might then get business facilities, maybe like an overdraft, and then that's kind of tied to their home and things get really tangled and messy. I think that can feel quite stressful sometimes. And sometimes we're hesitant to just borrow ourselves, and it's almost like we go, oh, I have to have an overdraft, or it has to be a business lending facility. Whereas when we're thinking about these things, sometimes there's ways of raising that finance, where it's not in such a constrained environment, like an overdraft where you have to pay it off sooner and higher interest rates and things like that. So part of what we work with our clients in this space is, well, how can we be using, if they do have equity in a property, how can we be using that to make sure that they've got the funds available so that they can do things that they might want to in the business and that they're not cash constrained? Because especially when there's things that come, like opportunities come along, one of the most, I think, disappointing things, for many business owners is not being able to roll with those opportunities, and not being able to invest in their own businesses. So I think having people in a position where they're able to do that if they want to, can be very freeing.
Yes. Yes, I can definitely vouch for that too. So when it supports them instead of constrains them, you talked about it being very freeing. And is that the only emotional side of these decisions that you see up close?
I think having buffers in place and just having comfort. Sometimes you might have we might create funds that are available and you might not need to draw on them. But sometimes just having, I think, that comfort that you can, if you needed to, can leave us in a much better emotional position.
Because the
No.
chances of getting approved are
Yeah, they always say the best time to get credit is when you don't need it.
needed. So the difference between lending setup that creates calm and one that creates ongoing stress, is that just structure or is it something else?
I think it comes back to the flexibility piece. So a lot of the time when we're looking at lending and structure and strategy, for instance, a client might plan to pay off their home loan in 15 years, let's say. But we might set it up over 30 years purposefully. And, then they can still set up their repayments so that they pay it off over 15. But we know then we've got that breathing space if they did just need to drop back to the minimum repayment with the bank because there are other things going on, or because they want to divert their cash flow somewhere else that's going to help them in their wealth creation, that they can do it. So I think, sometimes it's having that flexibility to be able to change your plan within your control, not necessarily being beholden to the bank, the bank's beat of their drum.
It's always a good idea to kind of aim for the 15, but life happens, right? You never know what's around the
Absolutely.
bend.
And there might be, and the other side sometimes when we look at it is great. Well, in 15 years, you've paid off your loan, now what? Whereas there could be other things that you maybe are doing that are helping to grow your financial position, at the same time.
So for founders listening know that they want to buy a home or explore lending but feel like their situation is too messy, where should they start?
Talk to an expert. Talk to an expert and let that expert not be someone sitting in the bank. Because if they're in the bank, they only have one perspective on it. Mm-hmm. Talk to somebody early on to find out what you can actually do. Because sometimes you might actually have a limiting belief around what you can do. And the longer you have that limiting belief, maybe that's stopping you getting into the property market, or maybe it's stopping you buying that extra property, or maybe it's stopping you increase the value of your home, actually finding out what you can do so that then you can be empowered with that information to make the right decisions.
What's the one thing that they could focus on now that would actually improve their borrowing position in the future?
The one thing you could focus on right now,
Yes,
given that we are in April, is reaching out and speaking to that finance expert before the year end is complete.
very good.
because now you have the opportunity to have some
Tweak.
control over how things are structured or tweaked.
Yeah. Yeah, no, that's good. And if you could leave business owners with one mindset shift around lending and borrowing, what would it be?
It might not be as bad as you think it is.
Yes, you are so right. You are so totally right. I should have just listened in the first place instead of doubted what was happening.
Seriously, I think, we often tell ourselves a story, of how hard it's going to be. And I'm sure that we can relate to other things where we've experienced this when we've actually gone to done it and been like, actually, that wasn't as hard as I thought it was going to be.
Tasks that we have on our list that we think is going to take forever, and then it literally takes 5 minutes, and you go,
Yeah.
why did I put that off for 4 weeks?
Yeah. And we've spent more than 5 minutes in moving it every week on our to-do list, right?
Yes. That is every business owner listening. And what would change if founders saw lending as something to design early rather than something to deal with when they need it?
I think as business owners, we have a innate entrepreneurial mindset, and we use that within the business, and think about all the things that we can achieve within the business.
They're jumping out of bed every morning screaming that, aren't they? So, I guess it's not all, don't put all your eggs in one basket. Yes, that's right. And it sounds like the goal isn't just getting approved, it's setting them things up so you actually have options. Yeah. Mm. Because you can quite often do, like I think we've done an equity release, right? So, and you can have it just sitting in there. It doesn't cost you anything until you actually use it, right? So, and I think that that's important for them to understand that that is what we're talking about when we're talking about some of those opportunities. You can have it ready, accessible, ready to go. It's just, and it doesn't cost you a cent until you actually use it. The age old good debt versus bad debt argument, right? That one never gets old. So, Melanie, this has been such a valuable conversation today. So, thank you so much for joining us today. What stands out for me is that lending isn't just a transaction. It's something that either creates pressure or creates options. And for business owners, that's the difference matters more than most people realise. So if you ever need any help, please do check out Melanie and Indigo Finance. This is the Business Rebellion, and this is what it sounds like to do business differently.